Whether he fires Powell or not, I don't think is really relevant. The Fed is itself irrelevant. I think silver's going to go to 60 to 70 this year. Sometimes the dues have to get paid. And I think the stock market is now topping. I think it is a major top.
So today's guest is Michael Oliver, and today we will discuss the state of the current economy, and we will talk about commodities, gold, silver, and a few of the other ones. So Michael, thank you very much for being here.
Good to be here.
Thank you very much, Michael. So we have so much going on now with the economy, and we just got news that Jerome Powell could be getting sacked from the government official. So I would like to ask you, what's your view, first of all, overall about the current state of the economy and this specific situation? Will we get the helicopters coming soon?
The We've got the U.S. especially, we have the biggest stock market bubble in history of the United States. Okay. You go back and look at 1923 to 29, the advance that occurred then with monetary expansion. Look at the bull peak in the 70s. Look at the bull dot-com top in 2000. Look at the move that occurred prior to that and how long it took. This time, it's instead of being a handful of years, and let's say tripling in the price of the S&P 500, it's been an 8 to 9-fold increase in the S&P over 15 years, and an 18-fold advance in the NASDAQ 100. So you say, well, the economy's been strong. Well, or look at an M2 chart, money supply chart, and it's an upward parabolic curve. Okay. They've been decade to decade, they decay the money by printing more. But over the last 10, 15 years, it's been even more than normal. Plus, they took interest rates of 10 of those 15 years to zero. Free money. Hey, well, it's like drugs, okay? And so people made decisions, investment decisions, families expanded, bought a new house, factories built new wings to the factory, hired more employees. A lot of spending decisions and investment decisions were based on the price of money. Well, they were delusional. Okay. So when you make a decision that is based on a big error, sometimes the dues have to get paid. And I think the stock market is now topping. I think it is a major top. It is laborious. Just like if you look at the 2000 top, in fact, MSA, Momentum Structural Analysis, my company got bearish in January 2000, said, if you're in this market, be gone. Okay. Well, what happened was it was a sell off into February, but then it came back up, made a new high in March, marginal, but a new high, comfy, felt good. And then just went sideways for the rest of the year. Whereas it wouldn't go down, it didn't really go up. And it was 2001 before they finally started to collapse. And that was when the Fed started cutting rates, by the way. Fed started cutting rates in January of 2001, about 5 months off the peak monthly close in the S&P. And only then did the stock market start to implode. You would think more free money would be good, right? Okay. And in 2007, it's when they cut rates after a lengthy pause in rate hikes in September of 2007. Again, a laborious top, up, down, but just wouldn't explode, wouldn't collapse. In October, it made its new high, final new high, 3 weeks after that rate cut, and that was it. They cut rates all the way down, the market collapsed. So, question is now, will we finally get a rate cut? And I don't think it's essential, but usually when you get a rate cut after a lengthy pause and the market's doing topping action, and our momentum work says it's topping, you can put a tombstone on the market. The rate cut marks the spot, okay? And so we have a president now who claims to be free market oriented and yet wants the government to artificially price money close to zero, and make everybody happy again. So anyway, whether he fires Powell or not, I don't think is really relevant. The Fed is itself irrelevant in the sense that they create the boom bust cycles by doing what you said, the helicopter money. Okay. And this time they've done it even more than they ever have in history, starting in 2008, 9, 10, and all the way. So they've created a monster, and when the monster starts to drop, they try to rescue it, but it never works. All they do is expand the money supply again, and it goes somewhere else. And you mentioned earlier in your talk, commodities. Yeah, that's one of the places it's going to go. Anyway, so I think the economy's headed south, but it will do it after the stock market starts to hemorrhage. And once the public realizes this new high was a trap, a bull trap, that's when emotion comes into play because people hurt. And then they get emotional. And that's when you get the kind of market and environment that I expect to see.
And would you, Michael, be looking for a recession or stagflation in this current situation?
Both. I'm looking for one, commodities to get a boost, not so much. In part, the commodities have done this before, by the way, where the world's gone into recession, and I don't know if we're going into recession or into depression, to tell you the truth. Money can flow into commodities. Now, most people say, well, that doesn't make any sense. How can industrial copper go up in a bad economy? Well, it does. Okay. You go back and look at 2007 and 8 in the commodity complex, they were soaring while the stock market was doing nothing, And then look at the late 1970s is a good example. Stock market was a total wasteland for 10 years. In fact, you couldn't make any money in this. It just sideways after a drop. And commodities exploded during that time, following gold, by the way. They were lagged too, but they followed gold at that time. Commodities have not followed gold since 2015 to 2020. They continued down while gold doubled. Okay. But then in 2020, late, they exploded. Commodities came up off their low. When I say explode, I mean off of historically cheap lows. They didn't really get the high levels. Like the Bloomberg Commodity Index got up to 140. Well, heck, if you look back to 2008, it was 237. So it was like halfway back to the highs. And then it pulled back after 2022 high in commodities. But over the last 2 years, if you look at a Bloomberg Commodity Index chart, you'll see a dead sideways market. Not going down, not going up, comatose, but way above the low that it made in 2020. It's basing. And we're literally a couple points away right now on the Bloomberg for MSA to put out a massive buy signal. We're watching some of the components, like copper's already behaving great. Platinum's suddenly woken up. Crude oil is about $3 or $4 away from a massive upside breakout on momentum, not evident on price. And I think when that happens, part of the reason for that will be money flow by investors out of a risk low reward category, the stock market. Once they perceive that, it'll go somewhere else. And the commodities are definitely quiet. They're cheap. Therefore, less risk, more likely reward. And I think some of that money is going to flow there. It's already obviously flowing into gold. So anyway, those moves by gold to the upside and an upturn in commodities, I think will be fair. The acceleration in gold that I think we've now entered, and an upturn in commodities will likely be pretty much in sync with the stock market topping out for a final time.
So you mentioned gold and commodities, Michael, and so gold done quite well already, as you have mentioned. And of course, we have a lot of structural issues. We have the deglobalization. People want to move away from the US currency because we've seen what happened with Russian assets. So the countries like China, if they want to do something that the West may not want them to do, they don't want to be dependent on the West. They want to own gold. But people, the generals, they're not involved yet. So that, of course, brings more optimism. If that does occur, that means there's a lot of more upside with the actual metal. But even with the miners, I believe, have even more opportunities. So what's your take on that, Michael?
Yeah, no, since that surge in gold, the miners, and silver that occurred in 2020, where we peaked in the summer of 2020 and that big surge, the miners and silver did better than gold in that surge. But since then, between 2020 and recent lows, the miners and silver, while they've gone up in price nicely, they've gone up a lot less than gold. So they've underperformed gold. Okay. Not like they're a bad place to be. It's just that they haven't matched the mama market. The technical evidence now is that when we monitor it, those spread relationships between silver and gold and the gold and silver miners versus gold is shifting, favoring them as opposed to gold. So if you'll look at just a simple price chart, which we look at secondarily, but in April, gold was where it is now. Sideways, up, down, but no real drops, just a sideways, dull situation. By the way, gold never, ever tops that way. It doesn't top with a quiet top. It tops with this peak and a collapse, okay? But anyway, so gold's gone sideways, cooling off. Silver's gone up during that time, especially the last 2-3 months. Miners, if you look at them, their behavior is quite independent of gold now. There'll be some days you'll have gold flat or down and they'll be up, which is highly unusual. And it's showing that some investors are starting to move money already into the miners, probably large portfolio managers who are maybe a little less enthused about the stock market nipping out a new high than the average guy is. And they're looking for alternative places to put the portfolios. And normally, if you go back and look at 2000 to 2002 bear market stocks, 2007 to 2009, during those times, there were two alternatives, gold and T-bonds. T-bonds are no longer an alternative. So you're left with really one alternative, monetary metals. And T-bonds, in fact, could become like a hand grenade thrown into a small room here, the way they're behaving right now, because they're acting like they could. You drop bonds right now, the T-bond futures, 30-year bonds, are trading in the 113, 112. No, excuse me, near 112 right now. Okay. You get down around 110 again, which we've been before in recent months. You get down around 110, another couple of points, no big deal. It could start to implode in a way that causes the central bank and the central government to panic. Yeah, it's not one of the Fed's mandates, the inflation, quote unquote, and the job market, or the economy. The federal debt is not one of their mandates, but it has to be because it's a time bomb and it's huge. And so you start to throw that guy off the cliff. One, it eliminates the alternative that always is there for paper, for money to move to, but it also panics the central bank into having to do something monetarily wise, whether it's one of their mandates or not. They have to save that market because it's their debt market. It's not somebody else's mortgage like in 2007, So we got real interesting times here. And I think it's like it's compressing to the point where it could get volatile and violent quickly.
And even at the current prices, the commodity prices, Michael, the miners, at least the good ones, they're printing cash. They're making really good money. So that's where I see opportunities as well. We don't even need to wait for the price to go up further.
Oh, no, you're quite right. Yeah, in fact, gold hasn't gone up for 4 months. And look what GDX has done. Look what SIL has done. So the silver miners ETF, they go straight up. So the spread is moving in their favor. And frankly, if I were to throw out a ballpark number, at minimum, silver is likely in this surge. Right now, it got under 1% of the price of gold. In other words, you divide an ounce of silver into gold, it was less than 1% of an ounce of gold. It's now up to like 1.1, 1.14, something like that percent. It could easily go to 2% plus in a heartbeat. 2%, you divide an ounce of silver into an ounce of gold, has occurred 20 plus years in the past 50, meaning it's hardly abnormal to see silver at 2%. You don't even have to have dynamic market for it to be at 2%. And if you just went to 2%, that means silver doubles in relative value to gold, I think by the end of the year. Wouldn't shock me. Well, it's, would you rather be in something that doubles, compared to the other or not? Okay, miners, not necessarily by this year, end of the year, but over the next year or so, I could see them tripling in relative value to gold. Now let's talk about gold. What's reasonable for gold here? And I've said this in quite a few interviews. If you go back 50 years and look at the 1980 bull peak, it was an 8-fold move from its prior bear low. Then go from 2000, 2001 lows, which was around $260 gold, to the 2011 high at 1920 was another 8-fold move on a ratio scale. Well, our low was 1,050 in 2015. That means $8,000, $9,000 just to match two prior bull market peaks. And this time, I argue, we have massively more dangerous, implosive, and explosive factors underway in all markets around the world. Government debt market, US stock market, far more massive situations with wave effects that should be more powerful even than those bull markets. And another thing I tell people is I don't think gold's going to go up and make a peak and collapse again. I think when gold makes its next, quote, peak or goes to another stratospheric level, it could be money again. Meaning that's it. This government, that government, suddenly, all of a sudden, gold is money again, legitimate. And gosh knows what price gold might be when that occurs, which case it's institutionalized. So it's different this time. It's far different, more dynamic, and the outcome's going to be different.
And from the technical perspective, Michael, do you pay attention to the silver to gold ratio, to the commitments of traders report No?
Yeah. The ratio between silver and gold, yes, that is a technical factor. I'm not going to try to explain why does it do this or that. A lot of people like to have a reason. There are many reasons. The main reason driving silver and gold over the long term is the ongoing degradation in money, meaning the real value of fiat currencies is degrading and degrading and degrading. So gold goes up because it's money. Okay. It's really not going up. It's just all those money units are going down in real value. Okay. What else did you say about the? Oh yeah, COT report. Yeah,
yes.
That's one of my favorite things to ignore. Okay, I know a lot of people like to find something short term that causes them to be fearful or not be fearful. And a commitment of traders report showed a couple weeks ago, I think it was. I had two subscribers send me an email asking me, "Are you concerned about this?" And it showed that commercial side of the market was more heavily short than it's been in a long time. I didn't pay a lot of attention to, compared to when and when. And I said, I don't care about that. There's a couple reasons I don't. But first off, commercials normally are because they produce the product. Therefore, if they're short, they also may own the bullion coming out of their minds. And it could very well be that, let's say, over the last year, a lot of them simply, it's a subjective decision, remember. The miner doesn't have to hedge, or he can hedge to whatever degree he wishes. It's a corporate decision. A lot of these miners may have simply said, hey, man, silver's going up, and I kind of want to let it go because I want to make some money. I don't want to lock in a low price, when I might make a lot more by letting it run and not hedge it. So maybe they rode the last year up only 50% hedge, let's say, because they sort of collectively thought, hey, I'm going to make some money. And they did. Okay. But then silver got up to 37 or so, a few weeks ago. Now it's 38, 39. And it paused for a while. Maybe they decided then, let's hedge here. And so suddenly you had a shift from less hedged to more hedged, and that caused that number to jump. And another opinion of mine is, and I learned this a long time ago when I got into business, 1975, I got hired by E.F. Hutton, commodity division in New York, the headquarters. And chairman of the COMEX was also the head of Hutton's commodity department. And I apprenticed under him. I didn't know anything about technical analysis. And back then, I was sitting at the metals desk at Hutton, which was primarily a trading desk for copper miners that would hedge through Hutton. Okay. And a copper miner came in, a corporate CEO of a company that underwent almost bankruptcy in the prior year, I think it was, where he had decided, he, the head of the company, had decided not only to hedge, but to go short. So to have more than a short hedge position in copper because he thought it was just too high priced and ridiculous and so forth, thought he could make some money. It almost took his company under because there was a spike at the tail end of that bull trend where because of him primarily, he sat down next to me waiting to talk to the head of the department and said, I created that spike, me covering shorts to keep my company from going under because he was overly hedged. And and which I remembered. And so when these people sent me that COT report information a week ago, I recalled that meeting, that meeting with that guy, and realized, sometimes people in the industry aren't necessarily smarter than the average guy. They're human beings. They may know how to get copper out of the ground and how to refine it, but they don't necessarily know about market trends and how to analyze them. And so the fact that they might be more heavily short doesn't prove anything to me about what's going to happen to the market. They're not always right. Okay. Anyway, enough said.
Yeah, that's a very interesting perspective. So Michael, what's your opinion on uranium? Are you interested at all at these levels?
We got bullish on uranium. Was it 2018 based on annual momentum of uranium? Uranium then was like $20, okay? And we got bullish, and first time we ever got skeptical and thought a correction could occur was August of last year. Uranium had been over 100, was dropping back to 85. And at 85, we said, watch out, it's going to correct. And it could drop, under 70. Well, it got down to the mid 60s. And I think it's still laboring either side of 70 for the last handful of months. I think it's basing. I think the correction's over. I'm not quite sure when it's going to resurrect itself and put on another up leg. I don't have that much interest in it. It had a massive move, a quintupling in price from 2018 to 23. Nice move. So it's in a new price reality now, where if it was vastly underpriced, it no longer is vastly underpriced. That doesn't mean it can't go up. It just says, hey, that was the game. Yeah, it might go up again. And we don't see it as being risky owning it here, nor the URA, for example, which is the ETF of the miners, the producers of uranium. But I don't see it as a primary place to be. It looks safe enough to own. It's likely to go up from here, but you want to be in silver and gold and silver miners if you're looking for percentage gain.
Yes, I'm very much interested in uranium because of those fundamental structural reasons and the long-term contracts, because they help us to predict the price that the utilities will actually be paying for.
Oh yeah, yeah. Well, to me it looks like it's reborn. Certain assumptions about future reality of energy were wrong, and it's now the new reality again, and therefore it's going up. The question is, well, what percent gain? I don't know. I don't have an opinion on that. We didn't have an opinion when we got bullish at 20. We just knew it was going up big, fivefold in 4 years. I didn't know, but anyway, I think it's a place to be. The overall Bloomberg commodity index is ripe for an upturn out of this basing action. And a lot of commodities, you could almost throw a dart at this commodity category, that commodity category, are going to go up with it. So when that starts to occur, that will also help uranium because more money flow will be coming into just commodities in general and stocks related to commodities like URA, the ETF of the uranium companies. And it's acting quite good. URA is acting like, yeah, it knows that uranium's headed back up again because URA has already gone up to new highs. And I think it's probably smart on that. It probably does know it. And again, I don't have a target.
Okay. Thanks for that, Michael. So I would like to ask you a broader question about portfolio structure in the current environment with what's going on the
Mhm.
macro and with all the trends we're seeing. How would you go about structuring portfolio in the current situation?
Well, this is a very unique time. Uh, I personally own only monetary metals, nothing else. Like I'm bearish on the stock market, but I don't care if it goes down big or not. I'm not going to short it because its decline in percent terms is not going to compare to what silver's likely to do. I think silver's going to go to 60 to 70 this year. Okay. Meaning double basically from here. Uh, and beyond that, it may go to a couple $100 and beyond that. But I'm focused on the rest of this year, and it looks to me like the dynamic places to be will be miners and silver. But if I were a broader portfolio manager, I would be looking at stocks within the stock market that really don't correlate to the trends of the stock market, such as commodity stocks, grain related, agricultural related, uranium related, base metal miners, copper miners, and energy. I would watch crude oil very closely because it has suddenly become over the last, let's say, handful of months, the weaker among the commodities. Remember, it had a plunge back in April where you had a floor for 2 years on oil at $65, West Texas Intermediate, and you blew through that floor to the downside and went to like 55 in a panic. And we argued in our reports that's a bear trap. Don't believe it's going to sustain. It's going to flip back up. Well, sure enough, it did. And right now we're trading back above the 65 level, like back above that broken floor. Like, it shouldn't have happened. Okay. But you get up to 70 and close any month out in this quarter, it's $70 or higher. And like I said, that's $4 or $5 above we are right now. It's breaking out on long-term momentum. I mean, look at a price chart, getting back to 70 doesn't really break out over anything. But from momentum it does, and momentum usually leads price, and it says you're breaking out, boy. And I think at that point, oil could really start to surge again. And of course, what would that do? It would create panic because a lot of the people that voted for Trump, who don't normally vote Republican, blue collar folks, thought, hey, this guy can understands the real world and he's going to keep my gasoline prices down. I was one of his main things. Well, right now it looks like he's succeeded, right? Well, I'm telling you, the technicals argue that it could blow up big in a way that suddenly your gasoline prices go up by 30% quickly, like in a period of several months, once oil gets over that 70 level. And that will do a couple things. One, it'll hurt the average guy in the street because when he pumps that gas, he's watching that thing click, click, click. And that brings home to him the assumption that, wait, I thought this wasn't going to happen, which creates what? Uncertainty. Okay. What he thought was certain wasn't right. And it's also going to, upend one of Trump's promises beyond his control. This was going to happen anyway. And when you do that, all of a sudden, when uncertainty prevails based on real world things like price of gasoline went up 30%. Oh, that hurts, have to actually watch how much I put in, et cetera, et cetera. That creates emotion and panic. And all that combined impacts the real world in terms of what's going to happen next, what institutions are in jeopardy. I think when the stuff hits the fan here, and a rollover in the stock market will create your bad job numbers, by the way, and then the Fed will have to panic. Remember 2007 through 9, the average guy who wasn't in the stock market got laid off. He suffered big time. It'll be that way this time too. In fact, it's already occurring in reality if you look at the job numbers. It's mainly government jobs. Uh, anyway, we're facing a very dramatic reality, and I think it's going to not happen incrementally. I think it's going to
Yeah.
be like all of a sudden.
Very interesting times for sure. So, Michael, I like to ask this broad question because I have a lot of younger audience as well watching this. So, what advice would you have for a younger person who's still at the start of their well building path. And he or she has so many options: the stock market, the bitcoins, the Nvidias, the things that we're discussing right now.
Okay. Yeah.
What advice would you have for that individual?
Listen to your granddad, because he's probably the one who said something good about gold. Okay. The reality is, if from an investment time perspective, meaning decades or 10 years at a time, go back 3 or 4 years, gold's beating the S&P. Who would think that? Go back 10 years to the 2015 period when gold was making a low. Also, the stock market was having a pullback then. Gold's beating the S&P since then, 10 years, beating it from a year ago. You go back 25 years, summer of 2000. Gold is up 11-fold. S&P's up triple. Okay? All you have to do is just get dumb. Sometimes don't have to be nitpicking. Gold is real money. It holds its value when governments degrade the thing in your pocket. Yeah, just because something's going up also doesn't mean you're making money. Because we put out a chart that's laughable of the Venezuelan stock market. Just a price chart on the first page of one of our reports a month or so ago. And it's just this upward curving beast exploding off the page. Lovely looking thing. And we said, hey, why aren't you long the Venezuelan stock market? And of course, everybody knows, well, that's because they're destroying their money, and it's just reflecting the degradation in the piece of paper. So is a loaf of bread down there. It's probably doing even better, Same is going on here, just to a lesser extent. Our money supply grows almost double every decade. Lately, more than that. That means that if you bought a stock for $10 and 10 years later it's 20, you're not really making money in terms of the spending power of that money. Yeah, it's an on paper profit. And you've got to factor that into reality. And that's why gold went up 11-fold of 25 years, and the stock market went up triple or so. Where do you want to be? One of your pillars should be, I want to be in real money. So when you buy gold, you're really not investing. You're putting it in money that doesn't degrade. Simple as that. It's like a savings account. It's not a speculative thing. And then I would look at, from time to time, you have to reassess reality. And right now, our assessment is certain undervalued assets are worth having, and probably for the next couple of years. And that would be commodities. And again, we have a condition on that Bloomberg, which is now just below 104, I need to close a month out above 106.52 to put a precise number on it. You do that, it's launch city. Commodities in general will start to advance strongly because they're still dirt cheap, historically speaking. And so that would be a place to be, probably for the next couple of years. Commodity-related assets, stocks, so forth. Not government debt. Government debt's not safe, and probably for a good while it ain't going to be safe. And it could get very dangerous in the short haul. Panic city, which creates wave effects in other markets, negative wave effects. So I would stress right now, gold is an ongoing percent of your portfolio, gold related, and right now it would be the miners and commodity related stocks, and then be open over time as things change to other potentials, not general stock market.
Thank you very much, Michael. It's a very detailed answer. So those are all the questions I had, Michael. Do you have a final word for us?
Final word. It's going to get what we've seen, like in gold for the last 10 years, has been a staircasing arm wrestling bull trend. It's about to go vertical, but particularly silver and the miners are about to go even more vertical, to where whatever you saw as normal and got used to being normal, silver goes up 5 and drops 3, waits 3, 10 months maybe, then goes up another 5, drops 4. It keeps going up, but it keeps, torturing you. Okay, that's not going to be the case. There's going to be a point at which finally they go vertical. This is not uncommon in many bull markets. If you go back and look at a lot of markets will do this. when they've been held back for so long, they just unleash. And I think that's where we're about to see that kind of dynamic, not only upside in that category, but downside in the stock market.
Thank you very much, Michael.
Seat belts. Okay. Okay.
Thank you very much, Michael. I really enjoyed the conversation, and everyone should have a look at momentum structural analysis.
Thank you, Vladyslav. Thank you much.
Thank you very much, Michael.